The next series of videos that we're going to go through here now, these all deal with what we call the component costs of capital. These are all formulas basically, and we're going to show you how to calculate the cost of debt financing, preferred stock financing, common stock financing, and then retained earnings. When we get through with all of that now, we're going to combine it all together. I'm going to show you how to calculate what's called the weighted average cost of capital. And that's indeed the cost of capital that a firm would be concerned about. But first though, we're going to go through the component costs of capital, and I'll give you an example of each one of these, and at the end of it again, we'll kind of pull them all together, and I'll show you how to come up with a firm's weighted average cost of capital. Now the first component cost that we're going to talk about, this is debt financing. It could be, loans from a bank if you want, but predominantly in corporate financing, they're talking about bond financing. And the cost of debt after taxes is what we're concerned about when we talk about debt. Now the reason for that is that the interest on the debt is a tax deduction. It results in a tax savings, a cost savings. That cost savings reduces the cost of the debt. So the cost of debt after taxes, the component cost of capital for debt now, it's in this little block right here. It's the cost of the debt in the market multiplied by 1 minus the tax rate. Now the cost of the debt in the market is the yield to maturity on the bonds. And again, we talked about that in the previous video. You calculate the yield to maturity on the bond, and that's the number that we would put here as the cost of the debt in the market. The tax rate you use now is not an average tax rate or something like that. It's what's called a marginal tax rate. And the marginal tax rate is the rate of taxation on the company's last dollar of income. There's a graduated income tax rate in the United States. That means as you make more money, your tax rate's higher. And basically we're talking about the highest tax rate that the company's paid on their earnings, and we call it a marginal tax rate. And that's the tax you pay on your last dollar of income. And just as an example here, if we want to calculate the cost of debt after taxes for a company, and we discovered that the yield to maturity on the company's bonds in the market was 10%, and the company's marginal tax rate, their federal plus state marginal tax rates now, is 40%, then 10% times 1 minus 0.40, which is the decimal equivalent of 40%, that would give us the cost of debt after taxes on this financing here, this debt financing, at 6%. And we would refer to that 6% now as the company's cost of debt after taxes.